Most investors focus on what they buy and when they sell, but very few understand how time alone can decide how much wealth they keep. Capital gains taxes quietly reward patience and punish impulsive decisions, often creating a bigger impact than market performance itself. The difference between short-term and long-term gains is not technical jargon. It is a structural rule that shapes outcomes over decades. In this video, you will clearly understand how capital gains work and why timing matters more than most people realize. Like and subscribe to learn how smart investing systems protect your returns. 1. What capital gains really represent? Capital gains are the profits earned when an asset is sold for more than its purchase price. These gains are not created at the moment of sale, but accumulate over the entire holding period. Governments classify gains based on how long an asset is held because time reflects intention and behavior. Short holding periods signal trading activity, while longer periods signal investment behavior. This distinction allows tax systems to encourage long-term ownership and economic stability. 2. Short-term capital gains explained. Short-term capital gains apply when assets are sold after a brief holding period. These gains are usually taxed at higher rates because they resemble earned income rather than long-term investment returns. Short-term activity increases market noise and volatility. Tax systems discourage this behavior by reducing after-tax profit. Investors chasing quick gains often underestimate the tax impact and overestimate net returns. 3. Long-term capital gains explained. Long-term capital gains apply when assets are held for extended periods. These gains benefit from reduced tax rates designed to reward patience and stability. Long-term investing supports business growth, innovation, and economic development. Tax systems recognize this contribution and reduce friction on capital appreciation. Lower taxation allows more gains to remain invested, which strengthens compounding. Long-term gains shift focus from timing the market to participating in growth. 4. The role of time in wealth building. Time is not passive in investing. It actively shapes outcomes through compounding and taxation. Holding assets longer does not only increase potential growth, but also improves efficiency by reducing tax drag. Time aligns incentives between investors and productive assets. Short-term decisions interrupt compounding and increase friction. Long-term strategies allow capital to grow uninterrupted. Investors who respect time allow systems to work in their favor. Wealth accumulates quietly through patience rather than constant action. 5. Behavioral differences between traders and investors. Short-term strategies often require constant attention, quick reactions, and emotional resilience. Long-term strategies require patience, discipline, and trust in structure. Traders focus on price movement, while investors focus on value creation. Tax treatment reinforces this distinction by rewarding investor behavior. Behavioral alignment with tax structure reduces stress and decision fatigue. Investors operating within long-term frameworks make fewer decisions but achieve stronger outcomes. Structure replaces emotion, and consistency replaces urgency. 6. How taxes change net returns. Gross returns can be misleading without tax consideration. Two investments with identical performance can produce vastly different outcomes after taxes. Short-term gains lose a significant portion to taxation, reducing reinvestment potential. Long-term gains preserve more capital, allowing compounding to continue. Over multiple cycles, this difference becomes exponential. Smart investors evaluate returns after taxes, not before. Tax awareness transforms strategy from reactive to intentional. Net results matter more than headline performance. 7. Capital gains and portfolio turnover. High portfolio turnover increases exposure to short-term capital gains. Frequent buying and selling creates tax friction that slows growth. Low turnover strategies align with long-term capital gains treatment and reduce unnecessary costs. This improves efficiency without increasing risk. Portfolio design that minimizes turnover often outperforms active trading strategies over time. Less activity does not mean less intelligence. It means better alignment with compounding principles. 8. Planning sales and timing decisions. Strategic timing of asset sales can significantly impact after-tax outcomes. Waiting for long-term classification often increases net returns, even if price movement is modest. Planning exits around tax structure is a form of optimization, not delay. Investors who plan sales intentionally avoid reactive decisions. This creates predictability and control. Tax timing is a system lever that rewards foresight and patience. 9. Capital gains in long-term financial planning. Capital gains treatment affects retirement planning, wealth transfer, and portfolio sustainability. Lower long-term tax rates allow more flexibility in income planning. They reduce uncertainty around future withdrawals. Understanding these rules early allows better system design. Long-term planning integrates tax efficiency with asset allocation. This alignment creates smoother transitions across life stages. Structure replaces guesswork. 10. Why structure always beats speed. The difference between long-term and short-term capital gains proves that structure matters more than speed. Systems reward behavior that supports stability and growth. Those who align with structure compound quietly, while others chase activity. Speed feels productive, but patience produces results. Capital gains rules are not obstacles. They are signals guiding investors toward durable outcomes. Wealth grows where structure and time work together. Long-term versus short-term capital gains is not a technical detail. It is a system that quietly shapes investor behavior and outcomes. Those who respect time reduce taxes, increase efficiency, and strengthen compounding. Those who ignore it trade speed for leakage. Understanding this distinction allows smarter planning, calmer decisions, and stronger results. Like and subscribe to continue learning how intelligent systems turn investing into a predictable long-term advantage.